Peter, tax policy sending Americans packing for other jurisdictions. What's going on?
Well, the numbers certainly tell the story. The number of Americans, Eric, renouncing their U.S. citizenship rose 39% in the third quarter of this year. There could be many reasons why they did that, but one explanation is a new law that took effect in July that makes it harder for Americans to hide their assets overseas outside the reach of the Internal Revenue Service. And the law we're talking about here is the Foreign Account Tax Compliance Act, better known here in Washington as FATCA. It's a response to the revelations that UBS, other foreign banks, were actively pitching U.S. clients on schemes to hide their assets from the IRS. UBS, you'll recall, eventually paid a $780 million penalty, handed over info on 4,700 accounts. And in July, FATCA started requiring U.S. financial institutions to impose a 30% withholding tax on payments made to foreign banks that don't agree to identify and provide info on U.S. account holders. And with more banks complying to FATCA, more Americans making the decision simply to turn their American passports in. 776 dropped their U.S. citizenship from July through September. That's far more than in the same period last year. And so far this year, 2,353 Americans have renounced their U.S. citizenship, which is on track to set a new record for the year. This has been controversial, as you know. U.S., the only OECD country to tax citizens no matter where they live, and some folks out there with dual citizenship certainly raising questions about this change.
Ed, given all the problems we have in this country, should we be that concerned over what 776 people are doing?
No, we shouldn't. The problem is not people moving overseas. The problem is capital moving overseas. If you look at all of the studies, and I mean studies from right-wing, left-wing think tanks, right-wing, left-wing academics, you name it, they are virtually universal on this point, and that is that the most distortionary tax is not the tax on people, it's the tax on capital. So it's corporate taxes. And the reason is obvious. If you think about what's the most mobile factor, what's the easiest thing to move, if you're a German and you're trying to decide, should I put my money in a corporation over here, or one in Denmark, or one in Spain, or one in the UK, or one in the United States, the tax rate is going to have a big effect on that. So even if it doesn't move U.S. dollars out of the United States that much, the marginal dollar is not the U.S. dollar. The marginal dollar is the international dollar coming in. And that's the problem. Now, you know, I don't mean to say that having people leave the United States is not a problem. We certainly worry about that, especially if they're productive and active parts of our economy. But again, I would say this is a relatively minor issue. The big one is capital, and that's what we need to be focusing on.
So what's the best way to fix the problem? Stop taxing worldwide income?
Well, I am a fan of a territorial system. I think that helps a lot. But that's again a relatively minor problem. If you look at how much we would lose, say, through the inversion problem, you know, which got so much attention in recent months, even by the president's estimates, it's a really small number. You're talking about
That's true, but there is a lot of American earnings trapped overseas because companies like Cisco don't want to repatriate at high tax rates.
Exactly. But again, the more significant problem is the failure to see significant investment in the United States during the recovery. And that's not because of international taxation. That's because of our own taxation of capital. Our rates are too high. We don't treat capital favorably. And that's the bigger problem. It's not the international issue.
Peter, you want to jump in?
I do. I wanted to ask Ed Lazear his take on, I heard Senator Portman over the weekend say he thought that if Republicans took control of the Senate, that it would improve the chances for a deal on corporate taxes with this White House. First of all, I want to see if you agree with him. And what would the terms of that deal look like when it's obvious these two sides aren't close to an agreement at this moment in time?
Well, I think that certainly, first of all, I defer to Rob on anything having to do with politics. I knew Rob Portman very well when we were at the White House, and he's a terrific guy and very astute observer. I would think that as we look to the future, if I were thinking about what we would do, the president has already said that he'd like to lower corporate tax rates, and I think that there's a deal that could be had there. Whether that's the right way to do it, I actually prefer expensing some rapid depreciation of capital, but those are, in some sense, details. If we were to move in that direction, I think that's possible. Closing the corporate loopholes is something, again, that Republicans like as well. There are plenty of things that we proposed as part of the Bush team to reform the tax system that are consistent with what the president likes as well. So I think if a guy like Rob Portman got control of this, or Paul Ryan, who I think has been very effective in the House, I think that we could actually see a deal being struck. Now, obviously, it requires both parties to agree. We have to get not only the Congress to side with it, but the president has to decide that he wants to do it.
Do you actually think that's a possibility, though?
People change, and let's put it this way. I have not seen any evidence of that from this White House over the past 6 years, but there's hope.